The stock market is often portrayed as a fast paced world of chaos and excitement, but let's simplify it. Think of the stock market as a massive marketplace where companies sell ownerships pieces called stocks to raise money for growth. When you buy a stock, you're essentially buying a small share of the company and becoming part owner.
This market operates on exchanges like the New York Stock Exchange or NASDAQ, where millions of these trades happen daily. What determines the price of a stock? Supply and demand. If more people want to buy Tesla shares, the price rises. If they want to sell, the price falls.
It's a dynamic, ever changing environment that attracts investors looking to grow their money. For beginners, this can feel overwhelming. But remember, the stock market is nothing more than buyers and sellers exchanging value. Now, let's dig deeper into how the stock market operates. Companies go public by offering shares through an initial public offering, or IPO. Once listed, these shares can be traded by anyone on stock exchanges.
The beauty of the stock market is that it reflects the value of companies over time. For example, if Apple announces a breakthrough product, its stock value could increase because investors expect higher profits. Conversely, bad news like missed earnings or legal troubles can bring a company's stock price down. There are tools to measure the market's overall performance, like the S&P 500, which tracks the 500 largest companies in the US. This helps investors see how the market is doing as a whole, rather than just focusing on individual stocks. For beginners, exchange-traded funds, or ETFs, are a fantastic way to start. Think of ETFs as a basket of stocks that spread your investment across multiple companies. This diversification reduces risk while giving you exposure to the broader market.
Investing in the stock market comes with both risk and rewards. Over decades, the stock market has delivered higher returns compared to most other investments, averaging around 10% annual returns. However, this doesn't mean every investment is a win.
Stock prices can be volatile, rising and falling sharply based on news, economic conditions, or even rumors. This is why it's crucial to only invest money you can afford to lose and to have a long-term perspective. The longer you stay invested, the more time your money has to grow and recover from market dips. Remember, patience is your greatest ally in the stock market. Avoid the temptation of day trading or trying to predict every move of the market. Focus on long-term growth and let compound interest work its magic.
So, how do you start investing in the stock market? Here's a step-by-step guide.
Step 1. Open a brokerage account. Platforms like Robinhood, E-Trade, or Fidelity make it easy to sign up and start trading. Step 2. Decide your budget. Never invest money you'll need in the short term. Start small if you're new to investing. Step 3. Research your options. Look into companies you believe in, industries you understand, or ETFs for diversification. Step 4. Invest consistently. The best strategy is to set a fixed amount to invest regularly, regardless of market conditions. This approach, known as dollar-cost averaging, helps reduce the impact of market volatility. By following these steps, you'll build confidence as an investor and start laying the foundation for your financial future. Remember, the stock market rewards those who are patient, consistent, and informed.